Hey guys, welcome back to Everything Money. In this video, you will learn our thoughts on our wonderful interview with Mohnish Pabrai. We went to Austin. It's a 4-part series. If you haven't watched it, it's absolute gold. But we asked him the question everyone wanted. Why did he sell so much Alibaba this year? Why he loves Tencent? And he told us it's about tax loss harvesting at the end of the year, maybe shoring up some realized gains and losses. We'll get into all that right now. I welcome in Paul and Mo. Paul, give me your thoughts. We were always wondering about why he sold Baba. He hadn't so much come out with it. People were very proud of us that we got it out of him. And along similar lines as he's in love with Tencent. I want to mention all this, Paul. Give me your thoughts on all these topics. And hey, Mo, I love you. You know that. Go ahead, Paul.
So this is something that I've heard many, many times. The real positive signal is when somebody buys an investment. People only buy investments for one reason. And what's that one reason?
They want it to go up?
Well, they want to make money.
Yes, gotcha.
Right? They want to make money because you can short something and want it to go down in price and make money that way. But you want to make money. That's the reason. But why do people sell stocks or investments?
Yeah, Paul, educate me on this one because I realize the concept. Mohnish was saying, well, there's a 1,000 reasons why you could sell. What are some of them? And what are some of them?
Estate planning, buying a new home, renovating your house, paying for your kids' college education, buying a private jet, buying a bunch of hookers and cocaine in Miami in a binge-filled weekend.
None of this crossed.
1,000 reasons to sell a stock.
None of this crossed my mind. I guess you're right. I just kept on envisioning this as, why would you sell the stock of a company you believe in so much? Better
opportunity somewhere else. If you buy a stock at 10, think it's worth 20, it goes to 19. But you find another stock that is at 10 that could go to 20. Wouldn't you rather sell the $19 stock and buy the $10 one? Because now the $19 one's got to go to 38 to equate the same thing as the $10 one going, the new $10 one. There's 1,000 reasons to sell. Mohnish sold Alibaba because of tax loss harvesting. What that is he'd probably sold a bunch of stock that he had a big gain on. And he sat there and said, okay, well, I have a big loss on Alibaba. If I sell it, I can offset a lot of my gain, not pay taxes on that, but find a similar investment like Tencent, because there are laws in the IRS. You cannot sell a stock for a loss and then buy it back again within 30 days. And in that 30 days, a lot of stuff can happen. It can go up. It can go a ton up. And all of a sudden, you've lost out on a great opportunity. But if he finds another similar investment with similar credentials, with similar fundamentals, selling at the same discount, he can sell Alibaba, buy a very similar thing like Tencent, which he did, but still get the tax loss harvesting along the way. So he's essentially sold a stock that went to 10 that he thinks is worth 20, offset a bunch of gains on other investments, but still bought another stock at 10 that can go to 20. So in his mind, all he did was, I just saved myself a bunch of taxes because I went and bought another company that was selling for a big discount anyhow. That's the idea behind tax loss harvesting. And that can save you a lot of money. But in order to do that, you need to have other opportunities elsewhere. But this is a very smart strategy. He sold one underpriced asset with a big tax loss to buy another underpriced asset that has the same upside potential. It's a brilliant move. And that's why he did it. And he even said that in our interview.
Well, what do you think?
Yeah, I mean, he said it in our interview, and it was not the answer I was expecting. I was actually kind of taken aback by it, but it makes sense. And this isn't to say, I mean, had he not had a massive gain somewhere else and a big loss on Alibaba, who knows if he would have sold it? He didn't say that he doesn't like Alibaba anymore.
He would not have, Mo. He specifically said, I did this for tax loss harvesting.
Exactly.
So in order to do tax loss harvesting, he needs to have the gain there to offset.
So going to how do we still feel about Alibaba? I still feel great about it. I felt great about it the whole time. And I like where it's at. And I think he does too. He just found another opportunity and he created an advantage for his fund. He did a great job doing it. So.
But
Paul, go ahead, Paul. Sorry. No, go ahead.
So tax loss harvesting works when you have other opportunities out there at similar valuations that you view when you sell the one investment as a loss. That's when tax loss harvesting works the best. Because then you can sit there, you don't have to wait 30 days. You can go buy a similar investment with the same metrics. And that's the whole point of it.
Yeah, and if you go watch our interview with him, he explained exactly what he did and exactly which companies he bought and the scenario. And he said it worked out absolutely. He couldn't have dreamt of a better way that the situation of pricing worked out for him. he said everything literally lined up for him. So you get to see exactly what he did.
Paul, the more I listen to Mohnish Pabrai, I like Tencent more. You're saying you've told me it's not quite the same appeal to you. Give me your thoughts on Tencent and maybe the diligence you need to do to learn more about it, or if you want to.
I'm sure Mohnish is going to end up being right, and he did a lot more due diligence than I'm willing to do. And Alibaba just seems like so obvious to me, so I'm going to stick with Alibaba.
Mo, were you surprised by his Mohnish's love of Tencent?
No, I had listened to many interviews that he did and talked about Tencent, and everything that he said about Tencent, it makes a lot of sense. And he also looked at this company Prosus that's in Amsterdam, and they're affiliated, they're a subsidiary of Naspers, and I think he's invested in them as well. But all of his points that he made about them being more of a software company and they don't have as much they're not like an Amazon. He compared them to Amazon, and he said they don't have planes, they don't have shipping, they don't have all of this. It's really just software, and they could just create more businesses. And it makes a lot of sense of what he's saying. I think it's a great company. I think he's going to be right in the long run. But
yeah, so Paul,
I wouldn't be opposed to holding both. I should say that.
Yeah, I'm warming up to the concept too, but I have a lot to learn about it. And I guess maybe, Paul, as I say that out loud, he talked a lot about a sphere of competence, and I've heard other quotes where if you have to question whether you're where you're at in your sphere, whether you're in the middle or hovering toward the edge, that you're already out of it, right? And so what is that fine line, Paul, of doing enough due diligence on a company to understand it versus watching YouTubers who, I guess, sort of present themselves to due diligence, but maybe talking you into a company like Tencent? What do you think about that?
I have no idea. It's hard to sit there and say this is the right point. I guess you just know. You're never going to know everything. You're never ever going to know everything about a company or a piece of real estate or any investment you make. It's a very good question, Seth. There's no set answer of this is the right point. I think you just know internally based on yourself. Like for me, when I started to get a little anxious about Alibaba, going, well, maybe I'm missing it. That's what always should happen. Whenever a stock goes against what you think, you should go reevaluate. What am I missing? And I found that every single time I looked more into Alibaba, I felt like I uncovered more that made me feel better about it. And that's what has given me that confidence of saying, now I'm not worried about it. So Intel, if Intel goes to 35, even though I want it to, I'm still going to reevaluate it at 45, 40, and 35, saying, okay, is anything changed that makes you go, wait, your thesis was wrong? I don't know. Maybe there will be something that changes. I don't have a clue right now, but right now I've made enough of a investigation in the numbers, and that's why I like to keep my process a little bit higher level than Mohnish and a guy like Gary Mashuris, because to me, that's what works. But the second I have to go uncover inventory levels and all, too much for me. Okay, I don't want to know how old the inventory is, LIFO, FIFO, FIFA, whatever it is. I don't care. I just look at it saying, if I can understand the cash flow process and the business itself, that's enough for me. But I don't need to beat the market by 10% a year. I'm very content beating the market by 2 to 4% a year. Do options on top of that add me a few more percentage points. I will still have more money than I ever need. And that's for me. That's what works for me. Now, Gary, our friend Gary, is running a fund that has $30 or $40 million in it. So he needs to maximize his returns. So he's going to do a lot more due diligence than I'm going to do.
Even Mohnish, he said that they're very concentrated in their portfolio. They have about $750 million. They do due diligence. I mean, he's going over to, I can't remember what country that was, that he was going over somewhere in Europe, I believe, where he was going and speaking with the father-son CEO and Dynamic. He does serious due diligence on these companies before he gets into them. He understands it way more than we do. So that's what he has to do.
But look at his mentor, Warren Buffett. Warren Buffett, I remember buying a company in Ackart, Indiana, or whatever, and he said, I hope it's there because I never went and checked it out. Yep. And that's more of my speed. Like, I'm not trying to understand that. I do real estate deals. Literally, I need you to tell me the revenue, the expenses, the tax basis, and the utilities. If it doesn't make sense to me right then and there, I ain't doing it. It's just not going to happen.
I'm guessing normal folks don't have to worry about tax loss harvesting, Paul, wouldn't you say?
Correct. I mean, don't get caught up in those little minuscule details. Just focus on buying good companies at good prices, and you will do great. And be disciplined and work on your internal self on how you view the markets internally.
If this conversation speaks to you, make sure you watch the 4-part series with Mohnish Pabrai. We are looking forward to interviewing him again in the future.
We created all this software because our users wanted to be able to analyze companies without having to wait for us to make a video. This software allows them to do that. The things you get with this software, you get everything on this main page, the 8 pillar, all these tools right here, plus all the stuff coming. You get exclusive daily content. That's 1 to 3 videos a day that made by us just for our users. You get access to Seth Mo and I. You get 30 years of financial data, over 30 years of financial data. But most importantly, you get access to our community. So our community is over 6,000 people who've already bought this software. It's in a very organized chat. You can go in there and talk about everything imaginable, even crypto, even Tesla, all your value investing ideas, even personalized. We have people in there that are friends now. It's an incredible community. Join. All this is available for only $1 per day. There are 2 ways to sign up: everythingmoney.com or Patreon. The benefit of signing up directly with everythingmoney.com is we are not big enough to charge sales tax yet, so you're going to save on that sales tax for a while. And the other good news about the software is if you sign up today, every month the price to new subscribers goes up. So whenever you get your price, that is your price locked in forever. So this month it's $1 a day. Next month it's going to be higher. Last month it was lower. So when you sign up, we have people who are paying like 25 cents a day right now because they signed up so early. So sign up now, $1 per day, less than a cup of coffee, gets you access to all this. If you can change your returns by 1 or 2% to the positive or decrease your losses by 1 or 2%, this will yield hundreds of thousands, if not millions of dollars. $1 per day. Sign up now.
You get everything. And if you want to trade, you can join Mo. He'll show you all the charts and trends for trading. That is our take on tax loss, Alibaba, Tencent. We'll keep you updated. Thanks for watching. See you next video.